So as a public pension plan professional, I can't say I have a tremendous amount of insights to provide, but when I was originally asked to speak here today, the task set before me was to discuss emerging real estate trends. And I thought about it for a while and considered really what an emerging real estate trend is and what becomes investable for institutions. And I had a couple problems with discussing probably even a couple real estate trends individually. One is it's largely a function of scale and governance for the particular institution. And two, I was caught in the middle of reading The Black Swan and some other behavioral finance books that incredibly darkened my outlook on my own ability to help pick investments. So that said, I decided pitching things I liked was maybe not the best thing I could do and pursue. At Texas Municipal Retirement Systems, we have a 10% allocation to real estate, kind of traditional, 60% core, 40% non-core, and I am responsible for having plowed almost $1 billion into real estate in 2015. So, you know, when I say, or when you see a title of real estate valuations are not overpriced, it's not necessarily that that's my belief. It just happens to be what the headline of the article associated with things I said in Trusted Insight happened to say. So I was quoted, clicker. Oh, there we go. This was my headline. Couple learning lessons for those of you who haven't given a lot of interviews. Don't be particularly wordy with reporters, not a good strategy, and also don't give interviews the day before the leader of the free world is about to be elected. So maybe not my strongest move. However, it's not exactly what I said, and this is what I actually said. My personal opinion is I don't think valuations are tremendously overpriced. As I think about real estate, lower rates means higher asset prices make sense. In the low rate environment we're in, I don't think it's overpriced. Do I really regret that statement? No, but a couple of themes that all the CIOs this morning happened to speak about were one, they were really seeking to get compensated for complexity in their portfolios, and also trying to invest in relationships through time rather than product types. And I kind of took that to heart as I processed what I was going to say here just now. And the problem, I realized it built directly into what I wanted to say in my personal experience investing in real estate. The really cool, neat things, the things you want to invest in real estate don't often get compensated. And the best things we've invested in over the last 8 years at Texas Municipal Retirement Systems have been the simple things. And thinking about the simple things, I really tried to break that down into what drove that simple success, and it largely has to do with capitalization rate math. So I realize I take this math a little bit for granted, and I don't think about it often enough when managers tell me, oh, I'm buying at a 7 cap, selling at a 5, or something of the sort. It doesn't always make sense to me in terms of a calibration, and for those of you not engaged in real estate on a day-to-day basis, I suspect that's probably similar for you as well. So here is, courtesy of Green Street, basically a map of where cap rates have gone in real estate over the course of the past 25 years. I don't think there's really anything surprising on this chart, and people made a lot of money from 2000 to 2007, lost almost all of it, and have made a lot of money since then as well. And over the course of these time frames, generally speaking, individual business plans require buying cash flow or buying properties that based on hypothetical cash flows at a higher cap rate than you're going to sell it at. There's not a lot of genius that goes into real estate investing, although most of our real estate managers are geniuses, so I will provide that caveat. But long story short is, it's pretty simple what they're trying to do, even if the execution may not be that simple. So these charts didn't turn out quite as intuitive as I hoped they would, but effectively what you see here is your purchase rate, your purchase cap rate on the horizontal axis, and your selling cap rate on the vertical axis. And then the output cells being the return communicated in terms of a multiple. The math's not perfect here. Please ignore the math in the lower left-hand corner because I know that's a little bit distorted, but kind of right in the heart where you see the colored slides, you see that on an unlevered basis, if you buy at kind of a normal cap rate in the 5 to 7% range and sell at a cap rate 1% to 2% tighter, you wind up getting to returns that are justifiable, kind of 1.3 to 1.6 multiples. When you lever those up, those turn into returns that make sense for closed-end real estate vehicles and real estate managers to earn carried interest, and for institutions to earn their hurdle rate that they need to get in their real estate investments in order to even justify making those allocations in the first place. So that's the simplest slide. When you move on to the next slide, you lever that 50%, and I did skip over one detail here. This is probably what I would typically classify as a light value add deal. Business plan trying to increase rents roughly 15%. And there's a variety of other assumptions that could go into this, but that's what this chart is really calibrated off of. And as soon as you leverage it 50% approximately, you get to a 1.6 to 2.0 multiple. Listening to hundreds of real estate pitches over the past few years, generally, that's kind of the range of multiples managers pitch on an individual property level for us to earn. So the calibration is approximately correct here. And however, this isn't really how real estate investors invest, at least at my institutional level, where we aren't capable of doing direct deals ourselves. We invest through a fund vehicle. And here's what those returns ultimately turn into once you flow it through a fund vehicle, and you get to 1.5 to 1.83 multiples, roughly speaking. And by and large, almost every single fund that's been successful over the time frame down this huge cap rate compression curve has been basically in that range. So that comment said, it really made me think about, okay, if we're in an environment now that it's harder to get cap rate compression, or you're having to run more leverage in order to do it, note those blue cells. If you leverage those up a little bit more, you can get them into the green cells. And this is kind of what I've started seeing happening in the real estate industry, is risk really materializes in real estate markets in terms of liquidity and business plan execution timelines. So that doesn't really hurt multiples, but it does hurt IRRs over time. And if we're dealing with 1.3 multiples or 1.4 multiples, or we're having to leverage those multiples up more in order to get our baseline returns, are we really just taking more risk in real estate today than we could be in other asset classes? Now, I could probably talk all day about the relative value of real estate compared to other asset classes, but going back to the concepts the CIO panel discussed this morning about, particularly about complexity and real estate, is they commented that they were seeking niche opportunity sets outside of real estate. And I'm also in charge of real return. We've done some mining finance, we've done some agricultural finance, we've invested in infrastructure and various things around those. You can make an argument about what's better relative value on a risk-adjusted basis all day long. But long story short is the general thesis for real estate is I can continue to compress cap rates on individual plan level deals. And I think you need more leverage to do that, and real estate managers are starting to push that through their funds, either through credit facilities or explicitly higher leverage. So that's the cap rate math. Now, what strategies are out there where maybe these green boxes still exist? And there's a whole number out there. I realize I probably duplicated a couple things on here, and there are things I missed, but I'll go through a handful we've underwritten, and I'm sure a lot of you have invested in. The single-family rental market. We haven't done that directly. We have done it through kind of operating company vehicles. It's an excellent private equity business model, effectively because you need a management team to run these. Why we like the concept is you can take very small scale and make it very big and change the cost of capital that way. Why I don't like it on a real estate only basis is effectively that it's basically building on the same demographic trend that multifamily does, but requires higher and more complex property management practices, things that haven't really been developed. I think lots of people will make money here. I'd rather invest in the equity of the companies rather than invest on this individually. Another thing we spent a lot of time on was Latin American real estate and housing development there. Again, demographic trends suggest these markets are undersupplied, kind of the core thesis of what real estate is. And really what we were pitched time and time again was this is a really low leverage strategy. Well, how did the returns actually get made? You make a very small equity check. You write a very small equity check to a total capitalization structure, and you earn your equity returns that way by writing a small equity check. That is leverage, even if it's not financial leverage at the end of the day. And over the last 20 years, no one's made more than 10 to 12% in US dollar terms. Then I kind of underwrote well, what's the currency effect? Or how do I feel about the emerging market currencies here? And the thought process there was that if I was going to invest in Brazil or some of these other markets, would single-family housing be the only sector I invested in? Is it the best sector? I kind of settled on it probably not being a justifiable asset allocation for our institution. Again, do I think people will make money? Yeah, probably not for our institution. One interesting concept where we do have experience, again, the CIO panel touched on this briefly, and another demographic trend was the senior housing, student housing, and self-storage sectors that are kind of an extension of the core real estate sector now. They are all expensive. We invested back in 2011 into a core real estate product there. And kind of the additional complexity, the additional story, the additional cool factor, it hasn't panned out. We've trailed the rest of the broader market by 1% to 2% by investing in those things than the plain vanilla real estate at the end of the day. So kind of my general learning lessons are that complexity in real estate generally doesn't get paid because it's not simple enough.